Good morning, everyone. My name is Adam Livingston. So nice to be with you here again today. I know a lot of you guys watched my Bitcoin and gold video from yesterday. We talked a lot about how gold is reaching all-time highs, $3,800 per ounce, and how Bitcoin has followed gold's run-ups historically. We did some talking about what the Bitcoin price could be if the historical beta does follow this latest gold run-up, but what does that mean for Bitcoin treasury companies? It means that they'll perform really well. So today I want to talk about debt-powered torque in Bitcoin treasury companies and why having debt on the balance sheet will multiply the upside in true Bitcoin price mania. So before we get into ranking all the companies, please like this video and subscribe to the channel if you have not. I really appreciate your support and helping me spread the orange gospel to the masses. The fuel that's going to drive Bitcoin's price action in Q4 is not just Bitcoin itself, it is cheap fixed rate debt. Here are the physics. Assets, the sats, they ignite and then double, but the liabilities such as 0% convertibles sit there like frozen statues on the balance sheet. So today I'm not going to be grading balance sheets on prudence, I'm going to be grading them on the torque potential. The companies that will spotlight all did the same daring maneuver. They printed some debt, bought some Bitcoin, and locked the coupon at basically zero. When price mania hits, especially the kind of Q4 blown off that we have seen before in Bitcoin's history, these liabilities do not budge and the shareholders get to ride the vertical. So keep this mental model of equity equals the Bitcoin times the price minus the debt in your back pocket. I will rank 4 public names by how much that simple line will fling their share price upwards if Bitcoin revisits true euphoria. Details on the math and the leaderboard come next, but for now, just a reminder, in a Bitcoin moonshot, fixed rate debt turns a balance sheet into a slingshot. But remember, this is not financial advice, this is financial entertainment. Before we start to rank anybody, let's nail the algebra because this is the rocket fuel and we'll be using Sequans as the live guinea pig. Number 1, the Bitcoin holdings are 3,205. That is the payload that is sitting on the balance sheet. No gold, no treasuries, just raw sats. The Bitcoin price, we're going to use the 113K spot price as of Friday's close. You guys and I both know that the price can jump like a cat on Red Bull, but we're going to freeze it here for the moment. And we're going to look at the debt, the $189 million in convertible notes. This is the genius part. Money borrowed at zero, locked until 2028. It's concrete, it doesn't inflate, it doesn't float, it just sits. And we're going to talk about the basic shares outstanding post the 10-for-1 split. Keep that number parked because that is our divisor. Now we plug in these numbers to the formula and we get $10.43 above the $9.98 trade that I'm seeing right now on Google. And this is the exciting part. If Bitcoin doubles to 226K, which might be a little unlikely depending on your opinion, but that is a move that we've seen happen in less than a quarter before, and NAV per share blasts to $32.25. That is a 223% jump, while the debt doesn't move a single penny. So remember the slide as we march forward because this whole presentation is just this equation applied to 4 different cap tables. The bigger the orange debt box relative to shares means the nastier the upside when Bitcoin lights the afterburners. So here's the scoreboard with 4 companies we're going to be looking at today, 4 Bitcoin treasury names. We have Sequans, then we have the miner, Marathon, Strategy, and Smarter Web Company. And these are sorted by the one metric that matters for torque, the debt to BTC loan to value. Row 1 is Sequans with 52% LTV. Remember, 3,205 BTC on the balance sheet with the 189 million of debt on the liability side. So that means debt is more than half of the stack. That's why they are sitting in the gold chair. The minute that Bitcoin sneezes upward, their equity catches the full blast. Row 2 is Marathon. I wanted to highlight them because they have a solid amount of Bitcoin, 52,477, but only about $1 billion of zero coupon and 1% paper that you can see right here. That comes out to $998 million, which is less leverage than Sequans, but still plenty of jet fuel. Then obviously you have to talk about Strategy. Now they have over 640,000 Bitcoin, which is insane. They continue to just execute incredibly well, even when sentiment is terrible. Good job, Saylor and co. They have a lower percentage of leverage at 11%. 11.4%, but remember 11% of a mountain is still another mountain of torque, and they have these converts outstanding that their plan is to let equitize and turn into shares. And then with row 4, we have good old Smarter Web Company. They have a Bitcoin-denominated convertible bond, which is the least leverage in percentage terms, but because it is a microcap, even small NAV shifts swing the market cap like a pendulum. So focusing on this debt to BTC LTV column in a mania, the math is very brutal. At 52%, every 1% move in Bitcoin is roughly 2% to Sequans equity. At 16%, it's about a 1.2% for Marathon. At 11%, it's about 1.13% for Strategy. And then as you get down to below 10%, you start to look more like a BTC tracker spot ETF than a leveraged rocket. Metaplanet's sitting in that situation right now because I think that their current Bitcoin NAV is like 97x their outstanding debt, which they're just waiting in the wings to start issuing these preferred instruments. These are the torque coefficients that we're going to be carrying into the scenario modeling, so lock them in your head now. Detailed case studies for each name land on the next slides. Before we run the simulations, here are the guardrails that we're going to be locking in. Number 1 are the share counts. Sequans at 16.6 million ADS after the 10-for-1 split. Marathon's at 370 million, Strategy 283 million, Smarter Web at 291 million, all pulled straight from the latest 10 Qs or Aquis filings in terms of Smarter Web. These are basic shares only, no converts, no warrants, no RSU overhang. The benchmark prices $9.98 for Sequans, $18.49 for Mara, $320 for MSTR, and $1.32 for Smarter Web Company. This is our starting altitude before we ignite the Bitcoin thrusters, hopefully this Q4, and we're going to be using the Bitcoin reference price of 113K spot across every calc so people can compare apples to apples. When we model a double, we simply crank that number to 226,000. You might be asking, Adam, why are you using basic shares instead of fully diluted? Well, I'm trying to illustrate the pre-conversion torque, the moments when the debt is still hanging on the balance sheet and every Satoshi of upside hits equity like a sledgehammer. Convertible notes only turn into stock after share prices blast through their strike levels, but until that trigger, those extra shares are a contingent promise, not real dilution. Showing the basic shares keeps the focus on the core question of how much does fixed rate debt amplify the first leg of a Bitcoin price mania. Don't worry, you can run the fully diluted math if you want to. Even after every note converts, the trade still works. It's just less dramatic. But for teaching pure leverage, basic shares tell the cleanest story. For simplicity's sake, here's what happens when we simply double that 113,000 spot price to 226,000. No fancy Monte Carlo things going on, just a clean 2x price shock. Because Sequans carries that 52% LTV, the equity responds with roughly 2.1 times the Bitcoin move. The NAV per share rockets to $32.25, which is a 3-bagger, while Bitcoin itself only 2 bags. With Marathon at a 17% LTV, the beta is a 1.2x, so a Bitcoin double converts into a respectable 59% pop. The NAV would go from 1330 to 2932. Strategy would be a plus 50% because of the lower leverage, but remember the law of large numbers, a 50% lift on 640,000 coins is still a $36 billion equity windfall. And then we have a minimal debt microcap float with Smarter Web Company. The percentage torque is smaller, but a 40% NAV swing on a $140 million market cap can re-rate the stock overnight. Now, these companies show smaller percentages because their current prices are already embedding a chunk of BTC premium. They are trading above a 1.0 MNAV. The takeaway here is that equity beta is basically 1 divided by 1 minus the LTV. That is the multiplier that is baked into every future Bitcoin move until the debt converts or matures. So when people ask me, why would you want debt on your balance sheet in a Bitcoin bull run? This slide is the answer. The debt is the fulcrum, Bitcoin is the lever, and the equity is what gets launched. Sequans raised $189 million of 0% convertibles back in July, no coupon, strike price $2.10 per ADS, and they stapled on 20 million warrants for dessert. Translation, they bought Bitcoin with effectively free money that doesn't bite until shareholders are already dancing in the aisles. That note pushes their loan to value to 52%, highest in the table. And this is why you're going to have the leverage that you can really feel in a Bitcoin bull market. People will glance at this and think, wait, isn't the stock trading at a discount to its Bitcoin? Well, I'm using a different yardstick. Sequans numerator is the enterprise value, which is the equity plus the net debt. My nav chart subtracts the debt first, then divides by shares. So same ingredients, but two different recipes. Today in this presentation, we're talking about the equity call option torque, which is exactly why our NAV per share clocks higher than their MNAV multiple. So the bottom line is that Sequans is a small cap with an oversized booster strapped to its back. If Q4 does go vertical, this is the name that outruns the pack on a percentage basis. This is not my opinion, this is just the math. But remember, not financial advice, this is financial entertainment. Marathon went really big last spring. They sold nearly $1 billion of their 0% paper maturing in 2032. Strike price on the convert is $20.26, and management layered a capped call on top. Think of the capped call as an insurance policy up to roughly $30, which means the note holders can't dump shares on the market, so the common stock enjoys the first leg of any rally dilution-free, which is pretty nice. There is some secondary debt. There's that residual $48 million at 1% due 2026. Tiny in scale, only $48 million. It barely nudges leverage, but it's good to know that it's there. They have 52,477 BTC in their treasury as of the August 25th ops update. It is a $5.9 billion treasure chest at a 113K spot price. And if you run the beta math on Marathon, every 10% pop in Bitcoin translates into roughly a 12% lift in Marathon's NAV per share. And because they're a miner, they generate enough cash flow to pay the token coupon on the legacy notes, so the carry cost is effectively zero. So Marathon's giving you that mid-teens leverage ratio, a monster pile of the self-mined Bitcoin, and a capped call that shields you from the early dilution. It's not as high octane as Sequans, but the sheer size of the stack means that Marathon moves the equity needle by billions of dollars when Bitcoin starts sprinting. Strategy, what the rest of Wall Street still calls Microstrategy, has built a 6-layer wedding cake of converts. Coupons between 0 and 62 basis points, the face value $8.24 billion, maturities 2027 through 2030. In plain English, they borrowed at next to nothing. Everybody knows this. They spaced the playbook, so no single year tanks their entire balance sheet. Because the debt stack is only 11% of their assets, the equity beta is a modest 1.13 times. But remember the denominator, a 1% tick in Bitcoin injects $720 million straight into shareholder equity. No other ticker on earth gives you that much dollar delta per basis point of Bitcoin. Strategy is not your adrenaline shot like Sequans, but it is the blue whale trade, lower leverage, absolutely massive torque in dollar terms, and a debt ladder that's built to surf multiple cycles. And Smarter Web is not playing the usual convertible note game. They issued a $21 million bond that's actually denominated in Bitcoin, which is quite interesting. It comes with a 5% equity premium and an auto convert trigger. If the share price rallies 50% and holds for 10 straight trading days, bondholders flip it into common stock. Because the principal is payable in BTC, the real debt burden shrinks when Bitcoin rises. Think of it as a mortgage where your house keeps doubling in square footage while the loan stays the same size. The leverage literally self-amortises. They hold 2,525 BTC in their treasury, which is peanuts next to strategy, obviously, but it's still meaningful for a micro cap. Loan to value is only 7.4%, so the conventional beta math gives us 1.08 times the Bitcoin move. But on a market cap of roughly $140 million, even a $50 million NAV swing can produce eye-popping percentage moves in the stock. So Smarter Web, I think, is not the torque king necessarily, but it is an elegant little option on Bitcoin. It has low coupon. The delta is going to melt away as the Bitcoin heats up, and the microcap float means tiny absolute gains translate into outsized percentage charts. And I think the market's rewarding Smarter Web Company with the highest MNAV right now. It's at around a 1.8. because there is still that expectation that they can get an outsized amount of BTC yield due to their size. So I think Sequans owns the leverage crown as you just look at the math and the debt on the balance sheet, but the dollar delta monsters are Marathon and Strategy. But a 10% Bitcoin pop stuffs billions of equity value into their caps, courtesy of their 50,000+, 640,000+ coin treasuries. There's a difference in valuation methodology. Obviously, we're all working through this new asset class together, but I think you're going to hear two multiples out there. MNAV, obviously enterprise value divided by BTC value, debt in the numerator, or you can look at the NAV per share, the debt subtracted first, then divided by the shares. Right now, that metric is telling you that Sequans is trading below its coin pile, and I'm just trying to spotlight how much of that pile belongs to common stock once the debt is paid. You can go ahead and run your 3x, 5x Bitcoin scenarios. Now, I don't think that we're going to have $1 million Bitcoin necessarily this Q4. I don't think anybody realistically thinks that. But if we see even BTC at 160, 170, I'm trying to illustrate how much debt plays a part in the outsized returns. So that's the toolkit, kids. Use it and you will know exactly which Bitcoin treasury rockets deserve a seat in true Q4 price mania. Thank you so much for listening. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please hit the like button, subscribe to the channel so I can spread the orange gospel to the masses. Have a terrific day. Don't party too hard. Class dismissed.